I wanted to extend the conversation that we had in our last video, where we talked about 3 or 4 things, I think. The first one was how to diversify our portfolio across different geographies, depending on which economy we hail from. And secondly, how to diversify our portfolio across sectors and industry verticals, ensuring that they have a substantial tailwind propelling it forward in the near to mid-term or even in the long term. And once we are through with that part, it's equally kind of important to identify market leaders in each of these verticals and not go for second-run companies, because the kind of business cycles we have seen over the last, I think, 30 years, if not more, is that if you are a mega company in a mega trend, and if you are doing really well, if you have kind of deciphered the equation to succeed in a particular sector, if you are consistently increasing your market share at a certain pace, then chances of you as a market leader, continuing to be a market leader in the near to long term is of course higher, vis-a-vis a second-run player kind of upgrading itself to become a market leader. Of course, it can expand its market share considerably, but it might not be enough to dethrone the market leader, who have been consistently gaining market share, been consistently improving their processes and their products and services, and most importantly, if they have been disrupting themselves instead of someone else coming in and disrupting them. So as long as we can kind of tick off these 3 boxes, we should be relatively safe when we're investing in a particular equity. And the 4th thing that we talked about is, of course, identifying companies based on certain fundamentals. And the 2 fundamentals that we talked about, ROCE, which is return on capital employed, over the last 10 years should be above 20%, and the sales or revenue growth over the last 10 years should be at least 10%, but ideally more than 15%. Now, apart from these 2 parameters, if you're looking at a company that has been, relatively well discovered by large institutional investors, both foreign as well as domestic, and also high net worth individuals in some capacity. If a company has been established as a market leader in a particular vertical, and the vertical has tailwind, then just looking at these 2 parameters and then ensuring. By the way, so I think this is a great point. So you have identified a company that you want to invest in, and you know that the fundamentals are all great, and you've ticked off all the boxes. Now, how do you enter the stock? At what levels do you enter the stock? Because if you enter at a level where where the particular company has topped out, and is overbought, then chances of that company correcting, is of course fairly high. And if the market overall shows a steep correction, then still the stocks that are kind of in an overbought zone, they will of course correct faster compared to stocks that are not in an overbought zone, or in fact are in an oversold zone, so to speak. So I think one way to do so is just by looking at the chart of a particular company. Just go to tradingview.com. It's pretty easy, and then just look at whether the company today, as of today, whether the company is trading at a level which is below the 200 DMA, which is daily moving average, and below 50 DMA, daily moving average. And the 3rd thing that you should look at in tandem is that the RSI, the relative strength index, which indicates whether the stock is in an overbought zone or in an oversold zone. Overbought zone is between 65 to 70 and beyond, where the RSI is 65 to 70 and beyond, and oversold is when the RSI is 35 to 30, and anything which is less than 30 is definitely in an oversold zone. And as long as the price is below 200 DMA and 550 DMA, it should be a very good level to get into, as long as all the other fundamentals are intact. So that's one way to identify whether this particular company is worth investing in today or not. And of course, Look, ideally, you would want to, look at the intrinsic value of the company, calculate the intrinsic value, using DCF, which is discounted cash flow. But why go through all that? I mean, if you can simplify the process, because there are lots of things you can do. For example, look at return on equity, return on asset. Look at earnings per share. Of course, EPS is a very important parameter, but there's no end to the number of parameters you can look at for a particular company. But more parameters you look at it, all you would do is create a analysis paralysis kind of a scenario. So don't overcomplicate things. Just look at these 3 or 4 parameters that we talked about, and I think as long as you're looking at market leaders in a particular sector and that sector has a tailwind propelling it forward, even poor companies will actually do well in these sectors. That doesn't mean that you should invest in those poor companies, because chances of the market leader doing well is of course higher. So it's always good to tick off all the all the right boxes and then hope for the best. Because even after you've ticked off all the right boxes, you can still go wrong. You can go terribly wrong. The position sizing is also equally important, because if you have to remember, if you're just investing 10,000 rupees in a particular equity, then even if it doubles, it's 20,000 rupees. It won't get you from A to B, right? So I think it's equally important when you identify a company that is worth investing in, and that everything is factored in, then you should go for a sizable position in that particular company. Only then will you see a decent upside in the future, a meaningful upside in the future. Otherwise, all the effort just goes down the drain. Thank you. Take care. Cheers. Bye bye.